Hey, everybody, it's another beautiful day in the neighborhood, another week to make money. It's October 19th. Let's rock and roll. Oh my God, this is so fantastic. I'll leave it up on the screen for the next 20 minutes so you can really study it. Oh, well, maybe not. Okay. So we've got a kind of a double shuffle here with the S&P. You can see we came down 3 days, but then closed higher at the end of the week. Purple predictor remains bullish, and I guess I have to remain on the bullish side as well. Dow Jones, buying pressure increasing, selling pressure decreasing, struggling to make highs here in the Dow. But the NASDAQ, we went and we almost made new all-time highs again. Now I need to stop here. You can see the purple predictor is bullish. But there's another thing that's starting to happen here. We're coming up to the old highs. Now let's go back to the S&P. We're coming back up to the old highs, okay? Now, what happens, I'll use the NASDAQ, but when you come up to the old highs, we really need to break through them. Now, we came up to the old highs and we sold off this last week. Now, there's a formation called a failure top, and this is where you go up to old highs and fail to make new highs. Now, so far, that's the case. We've failed to make new highs. But the formation is not really finished or completed unless we break the low in between the two highs. So that would be the lows we made like September 21st that week. If we broke those lows, this would be a significant bear move. So I'm nervous whenever we get close to old highs and fail to break them through, but it's really only been a few days. So we need to keep an eye on it, okay? Keep an eye on it. Look for them to break new highs. And if they don't break new highs, then it's time to start to get nervous. Seasonality, though, is solidly bullish at this point for both the stock market and the utilities. So this looks pretty darn good. And we are long stocks, as you know, and we are also long utility stocks. Seasonality, this looks like the bottom of the market. It looks like now we really we kind of shake and bake a little this week, and then we just start going higher and higher and higher. So let's go back to our failure top. We came down a little bit today, maybe we go up a little bit, then we go down a little bit, and then, according to the seasonality, we go make new all-time highs. Yield curve remains pretty flat because I think the Fed is manipulating it. Now let's just stop a little longer this week than we have for a while. We're no longer, obviously, in a negative situation, but we were in a negative situation in March of this year, and of course, starting in March of 2019. Normally, what I look for is a sharply positive yield curve to tell me that we're going to have a major, major big bull market. The way we are right now is this is bullish, but it's not major bullish. It's not monster bullish. So we got the little reflex rally from the bottom, the COVID bottom, and now we're kind of drifting around. We're not really seeing strong price movement in either direction, and partly because the yield curve is bullish, but not that bullish. We need to see it get more bullish, but the Fed's not going to let it get more bullish. They're controlling 10-year treasuries and holding them down, which means that the yield curve will remain slightly bullish, but not very bullish. The good news is it's not bearish. All right, asset allocation. We're still driving the stock market higher on the back of money coming out of the bond market. That's what this is telling us. The stock market risk indicator climbing higher. Now, this is interesting to me because utility stocks, which are usually considered a flight to quality, a flight to safety, they're doing very, very well. But on the other hand, NASDAQ's doing pretty well as well. Now, UTs are doing better, but overall, we're still seeing the market wanting to go into riskier stocks rather than safe stocks. Global shares came down hard. They had made a new all-time high and then failed. A failure top? Well, it's not really a failure top, but maybe it did fail at the top. All right, bonds came up a little bit and then sold off late in the week. As you'll see, all of our indicators are bearish for bonds. The Fed is manipulating them. The Fed is buying them, holding them up. And remember that if bonds go down, that means yields go up. So they don't want yields to go up, so they're buying. But every indicator I have, every single one, from the simplest to the most sophisticated, is telling us that bond yields should go up and bonds should go down. So that's my position right now. I am short bonds. So here we go, a big change here. So let's just start from the top, or let's start from the bottom, I guess, in a way. The green line is 10-year Treasury yield. So we just saw the price. This is the inverse of the price. Now, up at the very top is the price of gold. And you can see that gold is in a bit of a bear market, which does suggest that interest rates could go lower. But you have to look at the past behavior, and gold was in a major bull market from earlier this year until just recently. The next line down is the chart of the CRB. The CRB is the Commodity Research Bureau. It's kind of like the Dow Jones, only for commodity prices. And you can see it's kind of shaken a little bit here, but once again, it just finished a pretty strong rally. Now, as I mentioned a week ago, when you have a strong rally in the CRB and a strong rally in the gold market at the same time, which is what we've got, you typically have higher interest rates 6 months later. Well, 6 months later is right about now. So we are seeing them go up slightly, but the pressure of our gold CRB indicator is still very strong. And by the way, that indicator has never failed in the post-World War II era. The big change came in the blue line, and the blue line is interest rates in Germany, 10-year treasuries in Germany. And usually they're below interest rates in the United States, but they had recently been higher going back to March of this year. And they were pushing yields in the U.S. higher, but all of a sudden they collapsed as their economy is starting to collapse with greater COVID lockdowns. So now that pressure for higher interest rates is gone. So one factor is now saying interest rates should be the same. Every other factor is saying interest rates should be higher. The dollar, doing a whole lot of nothing. Gold, doing a whole lot of nothing. We're at the same price we were at the beginning of the month. And in fact, we're actually at the same price that we were in August and in July. So fundamentals are bullish, but the price action is not bullish. And we need to have both. We need the fundamentals and the technicals going in the same direction before we buy. So please ignore the Johnny One Note gold bugs. They are morons. That's Mo for Mo, Ron for Ron. All right, our indicators here, roughly neutral, a little bit bullish, but really we want to stand on the sidelines at this point or have a very, very small long position. I think I'm long one gold stock, and that's all. Crude oil, very stable. I think we'll just continue to be stable. Okay, this one's interesting. We told you last week I like being long Bitcoin. It's consolidating. I think the next leg is going to stay stable here. Now, why do I say it's stable? Well, the price action is bullish. We broke out of previous highs, but look at the purple predictor. The purple predictor is starting to degrade. The price action made higher highs, but the purple predictor did not. So it's not a big enough problem that I want to be short Bitcoin, but I think if you were long Bitcoin, I'd probably take profits here. It's probably not the best thing in the world to own right now. I think we're going to go sideways more than anything at this point. So I think I'm going to bail out of any long positions on Bitcoin. Okay, freebies, love having you here. Fully paid up members, hold on for just a second.